Welcome back guys, it's the Foolish Investor coming back to you with another hopefully not too foolish video. And as always, you guys know I hope you find something useful, helpful and informative in this video. So today I want to talk about Tattooed Chef. There was some huge news that the company did release a few days ago. I'm a little bit late to the story. I know I've seen a lot of comments in the previous videos asking me for my thoughts on the news that Tattooed Chef released. So I want to talk a little bit about that today. So if you guys are looking forward to it, if you're interested in hearing what I have to say, make sure you do stick around. As always, I hope you guys are going to like this one. So guys, what's all this news surrounding Tattooed Chef? Let's get into it. Let's start talking about all of this. So you guys know I'm really bullish on the company and I like to cover the company on the channel, so I enjoy making these videos for you guys. Now the first piece of really good news that we got was we actually finally got a confirmed earnings date for the company. So investors in the company, myself included, have been scrambling around for weeks trying to look for a confirmation of when this company was actually going to report earnings, and now finally we have it. We have the date as Wednesday, March the 10th, 2021 is when the company will officially report its Q4 earnings for 2020 and of course give us the full year report for the fiscal year as well. Now fortunately, we didn't have to wait up until the earnings call to get some kind of insight into how the company has done in Q4. So a couple of days ago, the company actually announced preliminary revenues for Q4 of $39.5 million, giving them a total for fiscal year 2020 of $149 million. Now this is really important because the company actually guided, and analysts on Wall Street were expecting $148 million. So it's not the biggest beat in the world, but it's a beat nonetheless, and I think it really helps set a good tone for the relationship between the Tattooed Chef and Wall Street moving forward. In a previous video, I spoke about the company and I said that they were basically sandbagging the numbers for now and the future because they wanted to remain conservative. They are a new company onto Wall Street, and my thought was that they're probably trying to remain conservative to kind of just maintain trust with Wall Street analysts. They don't want to go gung-ho heavy with really high numbers and then come in with misses, and Wall Street analysts are basically not going to be impressed with that. So by coming in conservative and beating, I think the company is doing something really good. And it gives me more optimism that the numbers that they've given for the future years are also possibly quite conservative as well, and hopefully we could see the company come in for beats on the numbers they've guided for 2021, 2022 and the years ahead of that. Now what else is really important is of the roughly $40 million the company made in Q4 of 2020, 24 million of that actually came from the branded Tattooed Chef products. Now that's really important because initially the company's biggest business was actually white labeling and selling white label products to grocery stores such as Walmart, Costco. That's what they did before they kind of ventured off into doing this own brand of theirs. So it's really good to see that the Tattooed Chef's branded products are now becoming the highest source of revenue for the company and growing at this really incredible rate. Now, was I surprised by the fact that the company came in with a revenue beat? If you guys follow the channel, you know that I wasn't. I did release a video a few days ago talking about how the website searches, the amount of people visiting the Tattooed Chef's website was really rapidly increasing in the past 90 days, suggesting that they were possibly getting a lot of e-commerce traffic and also that they were getting a lot of brand awareness because people are probably now more seeing this company's food and brand in places like Walmart and Costco. They also, before their last analyst day, reported that in the 60 days prior to that, they'd closed a lot of deals and got themselves into a lot of grocery stores. So all of that indicated that they should be coming in with a revenue beat, not just now, but possibly beating the guidance they've given for 2021 and 2022 as well. Now on the 10th of March, like I said, we will get the actual official earnings date. Some of the key things I'll be looking for and listening to on that date is what the profit margins were like, because that's going to be really important for this company moving forward. We want to see how they're operating on that front, how they're looking in terms of getting into new stores, any new deals they're closing, what kind of plans they've got for the marketing campaign, because we know they did all of this year without any real marketing, and they're going to be running their first marketing campaign in 2021. So it'd be great to get some more details on that in this earnings call as well. So I'll be listening to this attentively, and hopefully I'll upload a video after that as well and give you guys my thoughts on everything that they say in there. So how did the market react to all the good news about the Tattooed Chef? Of course, the stock went plummeting down. And to be honest, to people like myself and a lot of you who follow the channel, from seeing what you guys have been commenting on other videos, this is the best thing that could happen to us when it comes to a stock that we're bullish on, because the price has basically come down to being an even better bargain than the company already was. I already felt like the company was undervalued, and now it's just become even more undervalued, just making it even more attractive of a deal. And I've seen you guys commenting in other videos saying that you've been buying the dip on Tattooed Chef, and well done is all I can say to you guys. Now, alongside all of the good news about the revenues and the upcoming earnings, one of the things that some people might have an issue with is what seems like some dilution by the company. So the company's basically gone from around 70 million shares to now having 81 million shares, and this is all because of the exercise of some warrants. But what I'm going to do in the next section of this video is explain to you guys why this really isn't bad news and why I actually think it's really, really good news. And it actually made me like the company even more than I did previously. So the company actually had around 9.1 million publicly held warrants, and now these were exercisable. And what they did is they actually exercised these on a cashless basis, which basically means they allowed these warrants to go worthless. And the reason they did this, and the company has talked about this, the CEO has basically said that they wanted to extrapolate cash to benefit the company, but they didn't want to cause so much dilution to shareholders. So what they managed to do is turn this 9 million warrants into only 4.6 million shares actually being issued. But why exactly is this good news? First of all, when it comes to my price targets and everything for the company moving forward, fortunately it doesn't change too much. Thankfully, I was actually aware that this was going to happen quite a long time ago. It had been talked about since I think around 2 to 3 months ago, and all the projections of the future price targets I gave you guys, even though the company only had around 72 million shares outstanding, I was actually modeling in for them to have 80,000 shares outstanding. So now I do have to add a few more shares, around 82 million shares rather than 80 million shares. However, I wasn't modeling based on the 72 or 73 that they currently had. I was actually modeling based on them having this 80 million shares. So fortunately, the price targets don't change too much, and I'm really happy that I was modeling in just knowing that that was going to happen. However, the actual real good news is the company, from exercising some of these warrants, now basically has a cash balance of 200 million, which is just really, really good news for the company. It means that hopefully they don't have to dilute anytime soon, and they're able to do a lot of things with $200 million. Sam Galletti, the CEO, actually said that with the $200 million of cash on hand, we now have the ability to invest in strategic growth initiatives to accelerate our growth and enhance long-term stockholder value. So the company, they have mentioned previously when they had an analyst day, is that they actually are actively looking to make some acquisitions, and they want to make acquisitions of companies which are basically gonna enhance the growth that they see. Now with $200 million of cash, obviously it just makes possibly acquiring an accretive company a lot easier. So again, like I said, this is really good news. We've also mentioned that all of the results in 2020 came with literally almost no marketing. And now we know that in 2021, the company also plans to run its first marketing campaign. And again, having all this cash on hand means that they can actually spend money to get their brand out there. So having $200 million in cash is just really, really good news for the company. Aside from that, it allows the company to expand manufacturing space if they need to. It allows them to spend money in R&D. It basically allows them to remain competitive and innovative and keep coming out with new good recipe ideas. So a lot of times companies dilute, and it has a really negative effect on companies moving forward. However, the dilution here has been minimal. We've gone from somewhere around 70 million shares, I can't remember what the exact figure was, to around 80 million. So the increase isn't huge. And the company's bolstered its cash balance and hopefully is going to make really, really good use of that cash. So all in all, at this moment in time, I'm just more bullish on the Tattooed Chef than I've possibly ever been. Now, as I mentioned, the price targets didn't have to change too much because we'd kind of modeled in around 80 million shares anyway. Now we do have to increase that to around 82 million. I'll just check the exact number here. So it's actually around 81.5 million shares the company has outstanding now. Now you can see that doesn't really affect the target prices for the company because it's just really a minute amount of shares compared to the 80 million that we were already modeling in anyway. Now there is something else I wanted to mention in this video, and I just kind of wanted to give a kind of note of caution to you guys. So previously, when I gave you my price projections for the company, I based them on a multiple, a PE multiple for the company of 70. So I said I estimate they'll earn around $1 per share in 2025. And if we apply a PE multiple of 70, in a base case, we get a price target of $75. In a bear case, where we're kind of just estimated lower growth rates, you'd get a price of $67. And in the bullish case, the one where we project them to just grow even more than they've guided for, we get a price target of $94. Now, the point of caution that I really want to note here, and I'm going to show you guys an alternative to these price targets and then give you my thoughts on everything. So this was all based on the company having a price multiple of 70, and in my opinion, in today's current market, that was a fair multiple for the speed at which we were anticipating the company to grow at. So we were basically saying they're going to have around $150 million of revenue in 2020, and that by 2025 they should be able to scale that up to anywhere between 500 million to 1 billion. And that's where we have the base, bear and bull case. The base case was around 800 million, bear case around 500 million, and bullish case around 1 billion. These are all things that I could see as real possibilities for the company moving forward. But with the company growing at that rate and also growing profitability along with it, I thought a multiple of 70 is fair considering the current market environment. But if you've noticed, in the last few days we've had a massive sell-off, mainly of growth and highly valued stocks. We know a lot of that is because the yields have been rising, because people are anticipating inflation and higher interest rates. Personally, I don't think that's going to come for a little while, but the market is starting to price those fears in, and therefore what you could see is valuation multiples that are applied to companies being lower than what we previously projected them to be. So in this scenario, if we were to take our average price target, you're looking at a 275% return. If you buy the stock at the current price where it is today, that's a 30% annual return for your investment. So what I also want to show you guys, just so you guys have a note, take a note of this where we use the 70 multiple, but also take a note of this where we use a much lower multiple to account for the fact that maybe there's going to be a valuation reset in the market and stocks might not be valued at 70, 80 and 90 times their earnings moving forward. Now, this is still entirely possible, and this is still the kind of case I'm basing my investment on, but I also want to be prepared for the situation where that just doesn't happen and multiples are a lot lower. I want to see and be assured that if multiples are lower, will this company still be a good investment and could it still give me a good return? So if we keep absolutely everything the same and the only thing we change is we no longer apply a 70 PE multiple to this estimated earnings, we actually only apply a 40 multiple, so much lower but still very reasonable for a company growing at this pace. So you can see that changes things quite a bit. In our base case, the price target drops to $43, in the bear case around $39, and in the bullish case around $54. That gives us an average price target for the company of $45.35. Now this, like I said, is using a much lower 40 multiple. Personally, as long as we don't see a heavy valuation reset in the market, I'm hopeful that the Tattooed Chef should still be priced at kind of that 60-70 multiple that I showed previously. But I wanted to show you guys this scenario so you're kind of prepared for it, and it kind of also shows you the strength of conviction that you can have possibly in this investment, because if we do apply this much lower multiple, let's see if the investment still looks for a good one. So if we do get an average price target of $45 from the current price where Tattooed Chef actually is at the close of the market today, it's still a 115% return with a compounded annual growth rate of 16.5%. Now, if you were to do this to a lot of other stocks and you were to reduce the multiple that you attach on them in 2025, they possibly become not very profitable investments. But with the Tattooed Chef, what I really like is that even after reducing that multiple to 40 from 70, you're still looking at doubling your money if you buy in at this price. So I think that really kind of shows me that this company is really good value at the moment, at a time when the majority of the market simply is not. But like I said, I just wanted to show you this because we've had this kind of reset. It's been something that's been on my mind for ages, that at some point possibly valuation multiples could come down, and realistically when we're projecting out for companies, we should try to project out both scenarios and make sure the company looks like a good fit in either scenario, because you don't want to buy into a company that only looks like a good investment based off a 70, 80, 90, 100 price to earnings multiple and then 2025 comes around, we've got high interest rates and multiples are just a lot lower than that, and your investment just isn't any good anymore. So I want it to work under both. So if we do get this 40 multiple case, it's still a good investment. And if we're fortunate enough that the situation is such that valuation multiples are still as high as they are today in 2025, then we just get an even better return on our investment as well. So guys, as always, I hope you enjoyed this video. The next one I do hopefully will be a review of Teladoc's earnings. You know that Teladoc is a company I'm really bullish on. I started mentioning it to you guys in December when it was around $180. Stock has done really well since then, but has suffered a bit in the last few days as the market's been correcting. They did report earnings today. So far from what I've seen, I am impressed, but I want to go deeper, listen into the actual earnings call, and hopefully once I've done that, I'll update you guys with my thoughts on the company moving forward. But I hope you guys enjoyed this one. If you did, all I ask as always is that you smash that like button. It helps me out, it helps the YouTube algorithm out, but most importantly, it helps this channel grow. And if you're not already and you enjoy this kind of content, then make sure you do subscribe and join the Foolish Investing family. But until next time, do take care, and I hope to speak to you all again soon.